All right, today we're going to talk about mortgages, kind of the basic stuff about it. So, and what we can handle. So, the lowest interest rate that we can use to help refinance, get to our lenders, is a 4.25% interest rate. Now, rates are always adjusting, whether they're going up, down, so make sure you are keeping an eye on the portal. We'll make sure any updates are up. If we have to go higher rates, lower rates, whatever it is, we're going to keep you up to date as soon as we know. Now, the only solution you can do is help customers save money. You know, some customers want to get equity out of the home, but like I said, that's a whole different thing that we'll get into in a second. The only way you can help someone if it's lower or not a 4.25% interest rate is if they want to get equity to the home, like I was saying. What people do for this situation, there's many different ways you can get equity to the home to pay off other bills, like debt consolidation, you have credit card bills, car payments, student loans, medical bills, whatever it is. Some people like to do it for their own personal need. They want to do a new pool, house renovations, they want to buy a new car, a new boat, whatever it is, they pretty much just get cash in their hand and do whatever they want. What will happen is they'll just put it into the mortgage instead. So for example, someone takes out $20,000 in equity they have in the home, they get $20,000 in cash, we'll put that $20,000 down back on the mortgage. That's pretty much just how it works, but those payments now covered over the next 20, 25, 30 years, whatever they have the mortgage term to. Now, there's three different loans that we work with. There's a conventional loan, an FHA, which is a Federal Housing Administration, and a VA, which is Veterans Administration. So these are the three loans that we work with. Now VAs, as you can probably imagine, they're only for vets alone. Veterans always get the best rates, that's just a known fact. Now there's also two different types of loans that we work with. It's called a fixed rate and also an adjustable rate, or an ARM. A fixed rate is a fixed rate for the 25, 30 years, 15 years, whatever, how long the term is, but that rate will never change. An adjustable, or an ARMS, what that is that's the rate that will change after a certain amount of years. So there's a 3-to-1 adjustable rate, a 5-to-1, a 7-to-1, and so on. So you'll get a better rate to start. So for example, you might get a rate that's, say, 2.75 for the first 5 years. Once that fifth year hits, then the rate can jump up as much as 2% for every year following, just depending what the market's at. So if the market's at 7% and they get a good rate at 2.75, like I said before, the next year might jump up to 4.75, next year after that might go to 6.75, and so on. So if someone has an adjustable rate, you can pretty much transfer them over at any time to get out of that. The other option that we can help out with, if it's not a 4.25, is a second mortgage. So sometimes customer got equity out a while ago, or just got two different mortgages, they weren't approved for one, whatever the case may be. So if someone has a home that's worth, say, $400,000, they might have the first mortgage at $250,000, the second one, say, at like $60,000. We can refinance, get into one mortgage with only one payment, makes it a lot easier, usually a little bit lower interest rate as well. Now, in order to do any of this, the customer must be in the home for at least 12 months. The lowest loan amount that we can work with is $100,000. So for customers that have 40, 50, 60, or anything under $100,000, it's really too low to work with, not much savings, because there are closing costs involved with refinancing, so it just wouldn't really make sense. Now, here's a lot of things people don't know, is that we can actually work with rental properties. The only difference with this is that the LTV, or the loan to value balance, has to be less than 70%. So for people that own a home but live somewhere else and just rent it out, we can work with them, just make sure there's a ton of equity in the home, or else we can't really touch it. Now, the LTV, the loan to value balance, I'll explain a little bit more. The value is how much the home is worth. So if a home is worth $400,000, that's the value. Now the loan, or the loan balance, is what they have remaining on the mortgage. So if they have, say the home is worth $400,000, and the home has $300,000 left remaining on the mortgage, that's $100,000 difference. It's actually 25% of the home is paid off already, which means the LTV is at 75%. Now when you have the calls, you're probably going to want your cell phone to have a calculator, or an actual calculator next to you, so you can do the math. It's a lot easier when you're talking to a customer. That way you can know exactly what the numbers are, you're not going to have to scramble around, give them a few minutes. The customers want numbers right away. This is kind of what cold calling is, or when you're talking on the phone, you have to be pretty quick with it. Alright? That's the basic mortgage. We'll go into more options like streamline equity, all like that in some other videos, so stay tuned. Thanks for watching.